Assalamualaikum, I'm Fatinah and I'm the first presenter in my group. So I'm going to present about what is the meaning of financial market and also the functions of financial market. Okay, so first of all, what is financial market? Financial markets refer widely to any marketplace where the trading of securities happens, including the stock market, bond market, forex market, derivatives market, and so on. Financial markets are very important to the smooth operation of capitalist economies. The second one is financial markets also plays a very crucial role in allocating limited resources to the country's economies. It acts as an intermediary between the savers and investors by mobilizing funds between them. Simply put, business and investors can go to financial markets to raise money, to grow their business, and to make more money, respectively. There are 4 types of financial markets, which are money market, capital market, derivatives market, and also offshore markets. Next, what are the functions of financial markets in the economy? So, first function is financial markets help to efficiently direct the flow of savings and also investment in the economy in ways that facilitate the accumulation of capital and also of the production of goods and services. The combination of well-developed financial markets and institutions, as well as all of the financial products and also instruments, they suit the needs of borrowers and leaders and therefore the overall economy. Next, financial markets help lower the unemployment rate because there are a lot of many job opportunities that they can offer to everyone. So the next one is put savings into more productive use, which means a saving account that has money in it should not just let the money sit in the vault. Therefore, financial market, like banks, open it up to all individuals and also all companies that need a home loan, student loan, and also business loan. Besides that, financial markets also determines the price of securities. Investors aim to make profits from their securities. However, unlike goods and services, whose price is determined by the law of supply and also demand. Prices of securities are determined by financial markets. A security here means that it is a financial instrument, typically any financial asset that can be traded. Other than that, financial market makes financial assets liquid, which means buyers and sellers can decide to trade their securities anytime. They can use financial market to sell their securities or make investment as what they want. Asset liquid here means it is also a liquid asset that is a reference to cash on hand or an asset that can be readily converted to cash. An asset that can readily be converted into cash is similar to cash itself because the asset can be sold with little impact on its value. The last function is financial market lowers the cost of transaction. In financial markets, various types of information regarding securities can be acquired without the need to spend. The meaning of the point is that the trader requires various types of information while doing the transaction of buying and selling the securities. For obtaining the same time and money is required. But the financial markets here helps in providing every type of information to the traders without the requirement of spending any money by them. In this way, the financial market reduces the cost of transaction. That's all from me.
The primary market is where securities are created. In this market, that firms sell new stock and bonds to the public for the first time. Other type of primary market is offering for stock included private placement and preferred preferential allotment. Private placement allow company to sell directly to more significant investors such as hedge fund and bank without making share publicity available. While preferential allotment offers share to select investor, usually hedge fund, bank and mutual fund at the special price not available to the general public. The important thing to understand about the primary market is that securities are purchased directly from an issuer. Secondary market is defined as a market in which existing securities are traded among investors. The issue of the security is not involved in the transaction and does not receive the proceeds from sales. The difference between primary market and secondary market, the first one is financing. Primary market is help to supply fund to building enterprise and also to existing company for expansion and diversification. For secondary market, it does not provide funding to enterprise. Number 2 is how many times a security can be sold. For primary market, it's only once, and for secondary market, it can multiple times. Number 3 is buying and selling. For primary market, buying and selling in between company and investor, but for secondary market, buying and selling only between investors. Number 4, type of purchasing. For primary market, the type of purchasing is direct, and secondary market is indirect.
Assalamualaikum warahmatullahi wabarakatuh. My name is Mohd and today I will be discussing about the difference between money market and capital market. So what is money market? Money market has become a component of the financial market for buying and selling of securities of short-term maturities of 1 year or less, such as treasury bills and commercial papers. Nevertheless, the money market refers to trading in short-term debt investments. At the wholesale level, it involves large volume of trading activities between institutions and traders. At the retail level, it includes money market mutual funds bought by individual investors and money market accounts opened by bank customers. Next is, what are the examples of money market? Firstly, we have commercial paper. It is an unsecured loan issued by large institutions or corporations to finance short-term cash flows needs, such as inventory and account payables. Secondly, we have treasury bills. Treasury bills are governments, bonds, or debt securities with maturity of less than 1 year and to meet short-term in receipts and expenditure. Lastly, we have certificate of deposit. It is an issued directly by a commercial bank, but it can be purchased through brokerage firms. So what is the function of money market? Firstly, we have financing trade. The money market provides financing to local and international trades who are urgent need of short term. It provides a facility to discount bills of exchange, and this provides immediate financing to pay for goods and services. Secondly, we have central bank policies. It is responsible for guiding the monetary policy of a country and taking measures to ensure a flexible financial system. Through the money market, the central bank can perform its policy-making function more efficiently. For example, the short-term interest rates in the money market represent the described condition in the banking industry and can guide the central bank in developing an appropriate interest rate policy. Also, it helps the central bank to influence the stock markets and implement its monetary policy objectives. Lastly, we have commercial bank self-sufficiency. The money market provides commercial banks with a ready market where they can invest their excess reserve and earn interest. The short-term investments such as bills of exchange can easily be converted to cash to support customer withdrawals. So what is capture market? Capture market is where stocks and bonds are traded. Its movements from hour to hour are constantly monitored and analyzed for clues as to the health of the economy at large. the status of every industry in it, and the consensus for the short-term future. And the goal of the company institutions that enter into capital markets is to raise money for their long-term purposes, which usually come down to expanding their businesses and increasing their revenues. They do this by issuing stock shares and by selling corporate bonds. So what are the examples of capital market? Firstly, we have bond markets. The bond market is very diverse in its offerings, which is why most of the trades in this market are done by over-the-counter or OTC. There are many different types but let's us look at the main ones below, such as foreign bonds. Foreign bonds are issued in the domestic country by a foreign entity in local currency, and although this can pose a greater risk to the foreign entity due to currency fluctuations, it provides an avenue to capital that may be unavailable in its own market. Also, at the same time, it also investors to diversify their portfolio to reduce their exposure to economic fluctuations. Lastly, we have zero-coupon bonds. Zero-coupon bonds are bonds that are sold on the market at a steep of discount. This is because there is no interest to it until it expires, so essentially its value gains over time. Next example, we have stock markets. The stock market contrasts with the bond market in the fact that its offerings is comparatively simple, with few choices. In fact, there are only two main types of stocks. Firstly, we have common stock. Common stock is generally issued on the local stock market, and this is simply where the company sells a percentage of their company in return for a capital. Secondly, we have preferred stock. Preferred stocks are most specific to each company that offer a fixed dividend that is due each year, but it is not very guaranteed if the company has financial difficulties. However, the dividend can be backdated, meaning it is liable to be paid in the future. What is the function of capital market? Firstly, we have capital formation. There are people who have no immediate need for cash, investors, and those who need cash, debtors. The capital markets allow unused capital to be invested and employed. Secondly, we have ease of access and exit. In today's day and age, capital markets have become more increasingly accessible, with investors able to trade off their mobiles. The advancement of technology has made the capital market almost universally available. And thirdly, we have economic growth. By facilitating a marketplace for borrowers and lenders, the capital market creates a more efficient flow of capital. Long story short, let's distinguish the difference between money market and capital market. So for money market, it has a maturity of 1 year or less, and the risk is slightly lower. And the participants are commercial banks and financial institutions, mutual funds, and the return. The trade-off between risk and return is it has a low risk involves lead to a lesser return.
Spot market are markets in which assets are bought or sold for on-the-spot delivery. Spot market prices are the current prices of the asset. The spot market is where financial instruments such as commodities, currencies, and securities are traded for immediate delivery. Delivery is the exchange of cash for the financial instrument. Spot markets differ from futures market in that delivery takes place immediately. For example, if you wish to purchase company XYZ shares and own them immediately, you will go to the cash market on which the shares are traded, the New York Stock Exchange for example. If you wanted to buy gold on the spot market, you could go to a coin dealer and exchange cash for gold. The New York Stock Exchange (NYSE) is an example of an exchange where traders buy and sell stocks. This is a spot market. The Chicago Mercantile Exchange (CME) is an example of an exchange where traders buy and sell future contracts.
Futures markets are markets in which participants agree today to buy or sell an asset at some future date at a particular price. Prices at the futures market are estimated. A futures market is an auction market in which participants buy and sell commodity and futures contract for delivery on a specified future date. Futures are exchange-traded derivative contracts that lock in the future delivery of a commodity or security at a price set today. Examples of futures market are the New York Mercantile Exchange (NYMEX), the Kansas City Board of Trade, the Chicago Mercantile Exchange (CME), the Chicago Board of Trade (CBOT), Chicago Board Options Exchange (CBOE), and the Minneapolis Grain Exchange. Differences between spot market and future market. Spot market, goods are physically transferred from the buyers to the sellers in the spot market. Future market, in the future market, commodity exchange which are organized for making future contract which does not require actual delivery of goods from seller to buyer.
Financial markets have specific characteristics that make them distinctive and considered to have regulation on trading, as well as the costing and fees are well defined. Thus, financial markets are known as institutions and policies that help a smooth transaction process in all types of financial securities such as stocks and bonds. On the contrary, if the financial market does not exist in the economy system, the wealth of the economy would decrease and the current output and imports would not be as high. Therefore, financial market exists to allocate the supply of savings from the economy units with a surplus to those with a deficit. As a matter of fact, the economy would suffer without developed financial security system because the wealth of the economic system depends on it.